Good morning, everyone. Thank you for joining in on our latest Learning Saturday initiative. Um, I think what we would want to sort of focus on today, especially because it's front and center and debt has largely been an ignored asset class in 2025, is about how monetary policy is changing across the globe. So we're going to look at some major economies and how their monetary policy has been structured for 2025 and what the outlook is for these economies. And beyond this, we're also going to look at what's happening domestically. And one of the key takeaways from today's session is going to look at how bond prices react to monetary policy action and what that kind of relationship is, and how investors can prepare themselves to sort of set very realistic return expectations from an asset class like fixed income so that they know in advance what they're getting into, how it works, and when there is an opportunity to be able to grab that opportunity and participate. So without further ado, we're going to get on with today's session. So we follow a pretty standard format. There will be some time for the presentation, and any questions that you have, please feel free to type them into the chat box as and when it occurs to you. You may also leave it for the dedicated Q&A session, which we'll set up sometime towards the end of the webinar. So thank you once again, and let's get started. So a quick overview of the agenda. So we're going to talk about bond prices versus yields. We're going to look at global monetary policy actions as well as priorities when it comes to monetary policy. And lastly, we look at a few investment strategies. So if we look at the relationship between interest rates and bond prices, I think what we can understand is that it's a bit like a seesaw relationship. So when you see interest rates go down, typically bond prices are supposed to go up, right? And the idea is that an investor's yield, that is the return that they earn, is a function of how much they pay for the bond as well as the interest that they earn. So let's say the interest is always fixed at the beginning or at the time of issue, right? So you can never change the interest rate on a particular bond. What adjusts your return is basically the price. So when interest rates go up, new bonds are issued at a higher interest rate, right? So for somebody who is an existing bondholder, their bonds are paying them less interest. So there would automatically be an increased demand for new bonds and a decreased demand for existing bonds. So this is what would push bond prices down because the demand is less. So existing bonds go through a re-rating phase. Now, the opposite, of course, is true when interest rates move down because then newer bonds are issued at lower rates. So older bonds become more valuable and those bond prices go up. So the way to calculate an investor's return is through the yield, and the yield is a function of both what you pay as the bond price as well as the interest that you earn through the life of the bond. So that's why they have an inverse relationship. A lot of us intuitively think that a higher interest rate means that you should get better price appreciation of bonds, but that doesn't really happen, right? It's the opposite. So when we understand this simple relationship and we're able to see the logic behind that, we can understand what is happening in an interest rate cycle. But that being said, I think 2025 has been a year of learning for global bond markets because while interest rates have gone down, you haven't really seen that price appreciation in bonds yet. We'll also go into a little bit of detail as to why that hasn't happened and how investors can sort of position themselves to what's happening in the markets today. So simple illustration that you can keep in mind: when interest rates rise, your bond prices fall because essentially you want newer bonds which are paying a higher rate of interest. And when interest rates go down, your bond prices rise because there is a higher demand for existing bonds that are paying more interest. So I'm just going to walk you through your global inflation and growth metrics. So the top table is in terms of inflation. So if we look at target inflation, pretty much for all the advanced economies as well as China, you have a target inflation rate of about 2%, right? And whereas India is at 4%. So when we look at inflation, India is actually well below our target inflation. And if we look at projections, which we'll again get into a little bit later in the presentation, the expected inflation for this year is only about 2.6%. And the RBI has a window, or let's say sort of a corridor in which they would expect inflation to be, and 4% is the middle of that corridor. And inflation can range anywhere between 6 and 2%, and the RBI would be comfortable with that. So the way we are looking at India's inflation is that there's definitely room for inflation to go down. And this could be supportive to keep policy rates lower as well. But if we start looking at other economies, right, with the exception of China, every other major Western economy, whether you're looking at the Eurozone, or you're looking at UK, or you're looking at US, inflation has actually been well above that target of 2%. In the Eurozone, you're seeing some cooling which has come in primarily because of, I think, some reduction in energy costs. But US inflation is very much closer to 3%. And this is at a phase where the US has also been or has started cutting interest rates. And they are looking to actually bring rates down lower in the coming months and quarters. Now, while we've studied the inflation data, it also makes sense to look at what's happening on the growth front. So when we look at Q1 data, you see that the Japanese economy has actually expanded. So you had some moderate economic activity. China is actually rebounding. So from a slump in terms of a slowdown, I think the last quarter has been a fairly good number for China. The US growth has been good, but here, like as far as the US is concerned, there's a lot of uncertainty around tariffs, which are really putting pressure on in taking inflation up. But it's also affecting growth because the numbers could show that there's been more economic activity, which has been front loaded in, say, the first 2 quarters of this calendar year, which may not sustain in the coming quarters, right? Eurozone economic activity has actually been quite weak. So if we look at Europe as a whole, including the United Kingdom, your growth is really not there. And relative to growth, your inflation numbers are actually quite high. So this is not a good combination for any economy. Whereas India, from a macro standpoint, is doing much better because our Q1 growth numbers have come in at 7.8%. Q2 is also expected to be a fairly strong quarter. And we only see economic activity tapering off in the second half of this year. And at the same time, our inflation is much more manageable. So on the whole, I think India is doing better than some of the other economies that we're studying. So if we look at how inflation has changed in the last 1 year, I think this kind of shows us the divergence in what's happening across the globe. So if we look at Japan, inflation has actually spiked pretty significantly in the last year or so. So you've gone from being at roughly 2.7% inflation to 3.4 inflation projection for this year. China, on the other hand, is showing contraction. So Japanese interest rates have really not moved in 2025, which is a concern primarily because as your inflation moves up, your growth is not like you need to find a way to contain inflation. And interest rates are one of the tools that can help you do that. China, on the other hand, has been going through a contraction. And I think latest quarter data is showing some signs of positivity. But again, it's one piece of information, right? This is, you can't really call a trend based on one event. So China's actually been through a deflationary cycle. And that again is not good for economic growth and certain other parameters that we would like to study. When we look at the US, again, you're making some target like movement and progress towards that 2% goal. If we look at 2024 data versus 2025, definitely you're moving closer to that 2% target. But there are a lot of upside risks to inflation, primarily those that are tariff induced. And there is a sense that maybe these will not be one-time price level movements, but something that stays within the US economy for a prolonged period of time. And I think the recent inflation numbers as well as projections are pointing towards higher inflation in the US. The Eurozone and UK, again, I think UK inflation is much worse than what you're seeing in the Eurozone. But even there, your growth is quite anemic. And at the same time, you're having a high level of inflation. So when you have low growth and high inflation, this is typically a stagflationary kind of situation. It can spiral into higher unemployment and that can trigger the recession. But as of now, I think employment numbers don't seem to be too much of an issue across the globe. You are seeing weakness in US labor markets, but again, there's nothing alarming. You're just seeing the early trends, which could point towards a more deep or structural slowdown. India has made significant progress, and I think this is partly because one of the key contributors to inflation in 2024 were vegetable prices. And we've seen a cooling off on vegetable prices. So they're almost in deflationary zone on that basket, which has essentially brought your inflation number down. So the concern or the reason that we're still in a neutral stance, I think it's because of this factor. Because when we look at the way the RBI is projecting inflation for the rest of the year, you actually see that the first half is quite benign, and then you're seeing some uptick in inflation over the next few quarters. And more importantly, I think you're also looking at the fact that core inflation, which is excluding your volatile food, etc., is closer to the RBI's target of 4%. So this is basically what is holding us back in terms of rate cuts. There are a few other factors that also play into it, and we'll gradually get into that part as well. So just to look at how policy rates have changed between January and September in the last 9 months. So Japan has basically kept interest rates steady throughout 2025. And last year, when they increased interest rates, there was a lot of global turmoil around the yen carry rate, primarily sort of bringing more focus from global markets into how different economies are actually leveraged using the yen, because interest rates in Japan were near zero for decades together. And then you had this sudden increase in Japanese yields, and at the same time, your currency relationship was no longer favorable, right? So a lot of hits at the same time. You wanted the yen to depreciate, but it appreciated, which then made your Japanese or yen-based loans more expensive to service, both from an interest as well as a currency perspective. So what was considered to be a risk-free or a well-settled trade was no longer working. And higher yields as well as interest rates in Japan are going to again bring that pressure back to the forefront. When we look at China, I think there has been some easing in monetary policy, and this happened in May earlier this year. When we look at the US, we've started our rate cuts in September. So this is the first rate cut of the year. And we've moved from, say, 4.25 to 4.5% to 4 to 4.25%. And when we look at the Fed's dot plot, there is room for further rate cuts this year as well. Now, beyond this, Europe, again, has been consistent in cutting rates this year, with the ECB cutting rates in March, April, and June. So again, here, a lot of the rate cut activity has been more towards providing for economic growth. And lastly, if we look at the UK, again, here, you're seeing that the Bank of England has also been very proactive in cutting rates. The timelines, of course, are a little bit different from the ECB. So we've seen rate cuts in February, in May, as well as in August. So there is a need to sort of support economic activity across Europe, and that has been coming through lower interest rates. India has done 100 bips rate cut. So I think of all of the economies, India has been the most aggressive in sort of bringing interest rates down. And we had two rate cuts, one of 0.25% in April and another of 0.5% in June, with the RBI saying that there is more scope for them to cut rates. Got it. So quickly looking at Japanese yields. So if we look at how yields have moved up this year, you started off the year in roughly, say, at a 1.1% yield. So the yield is projected on the right side axis. So you can see that the start of the year, we were roughly at 1.1% in terms of Japanese yields. And you've seen almost a 55 basis point hike in yields. So while interest rates have kind of remained steady, so you can see that the green line, which denotes the Japanese interest rate, while that has remained steady, you've seen a steady sort of climb in the yields. So this is one of the main sort of contradictions of global monetary policy in 2025, where interest rates have either stayed the same or gone down, but your yields have actually climbed up. And this shows that there is a higher risk sentiment in global markets, meaning they are worried about what's happening from a macroeconomic or a fiscal standpoint, or just from a global growth standpoint. And this has caused yields to rise. You've also seen a significant up move in safe haven assets like gold and silver in 2025. So when we look at that kind of structure, uh, the inflation concerns, the growth concerns, a lot of this is playing into bond market fears, right? So at this point, any hike in interest rate, or let's say specifically in the case of Japan, there's a lot of concern around how inflation is being managed. So the yields are actually reacting to macro conditions rather than just the interest rate movement. Because just like equity markets are a little bit forward looking, even bond markets are a little forward looking. So there is a possibility that Japanese investors or bond owners expect interest rates to go up, and that's why you had your yields spike accordingly. Sort of con. So if we look at where growth is, the projected growth for 2025 for Japan is about 0.6%. And some of the key actions that the Bank of Japan has really taken is selling their ETF as well as rate holdings. So they are the largest owners of Japanese equities, and sort of also seen some easing in inflation that's happened, but inflation even at 2.5%, even as it is quite a bit higher than what the Japanese economy has experienced for the last 20 odd years. And their policy stance is still accommodative. And everyone, I think Japan included, is taking a very wait and watch approach to decision making. Primarily because everyone wants to make more data dependent choices. They also want to look at policy actions in a global context rather than in a local context, right? So Japan clearly needs to deal with an inflation problem, needs to increase interest rates, but with the interconnectedness of the yen, perhaps there are other concerns that are also weighing on policymakers. So if we look at the yen versus the dollar, we've had a depreciation and then you've seen an appreciation as well. Now moving on to China. So we had interest rates roughly at 3.1%, and then you had a 0.1% drop in interest rates. This is charted on the left on the y-axis. And here again, you've seen that yields actually went up and reacted in advance to the rate cut, and now they've climbed back up again. So you can see that there is some element of forward-looking nature to these changes. And again, here Chinese yields have expanded roughly 30 basis points. So you started out the year in 1.6% as your 10-year yield, and then we are now closer to 1.9%. So the Chinese bond market hasn't reacted as much as the Japanese bond market, but also I think need to keep in mind that we have had one round of rate cuts here. So what are some of the policy stance is accommodated when we look at the priority? I think for China, reviving growth is the number one priority. And part of reviving growth revolves around reviving inflation, right? So I think there is a misconception that inflation is bad, but actually some level of inflation is healthy for economic activity. So when you have negative inflation, it kind of shows that the economy is really not moving in any way, and that's why policymakers would try to lower interest rates, create more liquidity, sort of provide policies that stimulate more spending so that you can bring inflation as well as economic activity and then growth back. So lastly, I think because China has gone through a crisis in terms of its banking and non-banking financial uh, institutions, I think there the focus also has been on reducing their financing costs, which is directly linked to how the policy rate functions, and also stabilizing markets and sort of bringing investor confidence back into Chinese markets. So if we look at the growth rate from 2020 to 2025, you can actually see that from COVID onwards, the Chinese economy has actually been through a fairly stressful cycle. So of course, Q1 had a negative impact because you had your COVID announcements, and then you had a revival in Q2. But beyond that, you've been trading in this very narrow range of say minus or let's say 0 to 2%, with the exception of maybe 1 or 2 quarters where you had sort of or no. So China has, and like if you compare India's growth numbers in this period, 2020 of course was not a great year, but you had a revival in 21, 22, 23, and 24. So China has actually post-COVID has really not grown much. So there is that priority to bring economic growth back, to bring inflation back, and sort of that is, I think, where policymakers are heading as far as China is concerned. Now, moving on to the US, again, here we've had a long phase of keeping interest rates steady, and you have seen US yields come down in 2025. So prior to this, your yields kept rising, but overall the 10-year has come down. So you would have started off the year at around 4.5% and in terms of yield, and today I think we're roughly at let's say 4.2, right? So this is a pretty clear number as to where the US is heading and how yields have actually compressed there. So contrary to what everyone has been saying in terms of US yields not performing or bonds or having a sell-off, I think here the data clearly shows that at least on the 10-year side, your yield has softened a little bit, and there is room for more rate cuts as well. But the interesting thing about the US is that there are other drivers. So it's not just flows, it's also going to be about the overall macro economic condition of that market, primarily because you are a little bit worried about what's going on in the job space. Data there has not been super supportive. And I think one more data point will roll out this weekend on the job side, which should give us another piece of information that we can add into the matrix of what's going on with US markets. Right. So I think if we look at the actions, it's been the first rate cut since December last year. We entered into 2025 expecting US interest rates to be lower, especially because the commentary from the Fed was more dovish. But as we progressed into 2025, it became clear that inflation was the priority. And it's only since June that we've seen some kind of shift in the Fed's tone in terms of prioritizing the labor market as well. Right. So first, I think Jackson Hole was a milestone where the chairman kind of openly said that, this is what we need to be looking at, and there will be rate cuts in 2025. So until then, there was a lot of fear in the US markets that, okay, perhaps we're not going to cut rates or the rate cuts are not going to be very deep. And this move is essentially because you want to support growth and sort of deal with how the job market is sort of cooling off. And this is happening at a time where inflation is pretty high. So I think it's been almost 2 or 3 decades since the US cut interest rates when inflation was close to 3%. So that has not happened in a long time. And the US economy is actually not used to inflation or high costs of borrowing. So if we look at the summary of economic projections as well as the dot plot, we can clearly see that you are expecting rates to go lower, and a majority of policymakers are expecting rates to be between 3.5 to 3.75%. And if we look at that is for 2025, and in 2024 it goes even lower, right? So if we look at how growth is projected, I think we are seeing lower growth in 2025, and we are seeing some years beyond. Unemployment is sort of gone downwards, and your inflation is also showing a trend downwards. And your Fed funds rate is also showing a trend downwards, right? But this is a little bit of contradictory information, because ideally, if you were expecting unemployment to go down, you were expecting growth to pick up, and you were expecting inflation to moderate, there is no reason for you to change any interest rate at all. That's the ideal combination that you would like to have. Yet, when we look at inflation data, it doesn't look like it's coming down. The drivers for inflation, at least on the upside, look to be higher. At the same time, the labor market data is not alarming at this moment, but like peak unemployment does not coincide with the end of the recession, right? You tend to see unemployment sort of peaking out somewhere in the middle or like in the early phase, and then you see economic activity take a hit, and then only in the recovery phase you sort of start seeing better numbers. So you don't need to wait for maximum or like the highest level of unemployment to kind of call the recession. It tends to happen earlier. Uh, so given all of this, I think somewhere the numbers and the data show that the sort of situation going forward is not going to be that clear, and it's not such a neat, easy path that you can follow, especially given that there are so many moving parts, and we are 9 or 10 months into 2025, and we've still not settled on global trade. And the longer that uncertainty hangs over markets, the longer it's going to have an impact on economic activity, on policy choices, on currency trends. So all of this is going to be a little bit of a challenge to project and see what the net result of all these competing forces would lead to. So like I mentioned earlier, we've had 3 rate cuts in the Eurozone. Yields have only been going upwards. And this is something we need to be quite cognizant of, because here in Europe, the fear is very clear that markets are not, the economy is not really growing. So I think the reflection of why the yields have been going up is primarily because of economic growth concerns, as well as the fact that inflation, despite lower rate cuts or lower interest rates, that is that is stoking inflation pressures, and you're seeing a higher level of inflation in the Eurozone as well. So if we look at the key rates, your main refinancing, which would be your the equivalent of the repo rate, is roughly at 2.15%. Projections for inflation are showing a slowdown in 25 and 26, but growth is also expected to be even lower in 2026. So I think this is where a lot of fears around what's happening in the European markets is showing up in the yields. A similar story for the UK. Again, 3 rate cuts and different points in time. You are seeing yields decline a fair amount. So we've gone from roughly 4.6 to 4.7%. So not such a large spike through 2025. But if we look at peak rates, it's gone close to 4.9%. So you are seeing these spikes, and you are seeing a lot more volatility in the bond market. So as far as voting has gone, I think you are seeing a preference for lower interest rates across committee members, and there is a reduction in terms of bond purchases. So the kind of liquidity that's coming into the UK market is going to shrink. And of course, like I mentioned, pretty much all policy making across central banks is being data driven and is looking at domestic as well as global factors. So lastly, coming to the RBI, again, here it's been an interesting year. You have had 1% in terms of rate cuts occurring, and we are while yields have come down, I think your June was the bottom, and then you've seen yields steadily climb through this. This is broadly based on trade uncertainty, the fact that the RBI has kept the stance at neutral, and I think this week's policy or last week's policy kind of gives us some sense that there is room for the RBI to cut more rates, but they're also looking at a couple of things before they can make those decisions. One of those factors is global, which is very much outside the locus of control. The other factor is in terms of where our core inflation is heading, right? So the concern is that inflation could pick up next year. So, and we know that any monetary policy action actually occurs with a lag, meaning if you cut rates today, you're going to see transmission over a period of time. That's also one of the reasons why your rate cut reaction doesn't happen immediately. Right. So if you see bond yields actually rallied in this period between April and June, because that's when markets expected the RBI to cut rates. And then you've had an uptick because it's already happened, right? So you don't see, you can see the market react in advance to what the RBI really does. So, again, in terms of the latest meeting, the repo rate was unchanged and the policy stance also was unchanged, but two external members expected or preferred to keep the policy at accommodative rather than neutral. What came directly from the RBI governor's statement was that they expected that there was more policy room to keep rates easy. And this is primarily because the inflation projection has changed significantly. So when we started out, I think the inflation projection for 2025-2026 was about 3.1%. So today, the projection is almost 0.5% lower, right? And when we're looking at growth also, we're seeing much better growth numbers. So our Q1 GDP growth number came in as a surprise at 7.8%. Most people, especially the RBI, had projected a 6.5% growth for this quarter. And even Q2 numbers are going to be slightly higher. It's only from Q3 onwards that we're seeing lower growth metrics. And that's also, let's say, from Q4 and Q1 of next year. That's when we are seeing your inflation really pick up. And that pickup is a little bit high. But what we need to keep in mind is that those numbers are actually are lower than what they projected earlier. And this is despite the fact that 2025 will be a low base, a low base effect year. Meaning, if inflation has been low in 2025, then when we're in 2026, and we look back and we sort of compare, you're going to see, you might see a higher number because of where you're starting from. So I think that inflation is going to be one of the things that really drive the ability for the RBI to cut rates further and to create a more conducive and supportive environment for economic growth. So now, lastly, we will look at some investment strategies, and I think there are broadly three sort of strategies that an investor can follow. So one is to pair precious metals with debt. This would essentially give you a more defensive stance, and this is what we have done for investors in the last few years. We have helped them build these two layers. Now, in today's context, participating in precious metals is not a very value-conscious option because you've seen a significant rally. Many of the drivers that have sort of taken precious metal prices up may not be able to sustain them going forward. So And this is a strategy that if you have already worked on, then it's something where you need to look at looking profits and sort of restructuring your portfolio to the current context. The second way to do this is to have a duration plus accrual strategy. So a duration strategy is something where you take exposure to longer term bonds, and an accrual strategy is something where you're focusing more on the yield of the return and you're not getting any volatility from the bond prices, right? So this ideally, when you take a duration strategy, you're going to have more um, volatility in the portfolio because bond, like the longer the duration of the bond, the more it's going to react to any changes in interest rates or yields, right? So to balance out the volatility from a duration strategy, you need to have a layer of accrual. This would essentially allow you to temper down some of the volatility that the long duration bond gives you, and at the same time give you some benefit in terms of higher returns when your yield transmission actually occurs and you see the bond price appreciation. Slightly more aggressive investor is to look at pairing debt with equity. So this again is something that we have done for a lot of investors in the M2W program, where we've added debt as a layer to the overall portfolio, ideally to give you some more stability as well as a different driver of returns. So this is a way that we need to look at portfolios. I think there is a mindset shift that we all need to go through, because sometimes we're always looking at specific funds or specific investments and saying that, oh, this one is not performing. But when we construct a portfolio, we need to look at what the portfolio as a whole is doing, how the drivers of return are more diversified, and how that is helping you cross from one milestone to another. So what are some common mistakes that we see with investors in their portfolios? I think number one is no asset allocation. So if you are an investor who does not have adequate diversification in your portfolio, then do add a layer of debt. We are at a point where debt is very attractive and can give you the kind of risk-adjusted returns that are worth taking. The second mistake that we notice a lot is that many investors seem to be avoiding debt because of the taxation. So if you're very tax conscious, there are some hybrid products that can give you more favorable taxation than a pure fixed income product. At the same time, we think that tax should not be a driver in terms of asset allocation requirements, because at the end of the day, if you need to be safe, then you need to be safe, and it doesn't matter if you're going to pay more tax, right? So given the heated valuations and markets, it may make sense to look at a more structured option. And the third thing that we see is a lot of investors chasing performance. So when we look at AMFI data that comes in, there's a lot of SIP stock, and then you see SIPs going into new places. You see a lot of investors participating in NFOs, and many of these NFOs are popular themes that have done well. And we don't really see investors looking at safety and valuations as a driver for portfolio construction. And the last thing that we've noticed is that many people don't rebalance on time, meaning when you have a performer, you need to book profits and you need to move out. That can be even something like a precious metal or in a small and mid cap space, where we've seen investors collect really good returns, but are a little bit unwilling to sort of book those profits and move towards safety. So rebalancing allows you to actually create wealth, right? If you don't rebalance at a point in time, then that's just notional wealth that's there in the portfolio. And typically that rebalancing either happens much later or at a lower return level. So these are things that can be easily avoided with a process or guidance. And that's what we are able to sort of offer at M2W as well. So if you're very tax conscious, I think you could look at income plus arbitrage as a category. You could look at having dynamic bond funds where the fund manager will sort of rebalance the portfolio and you don't need to make any additional sort of like investments, and you don't need to adjust your portfolio according to the cycle because it already happens. Or you could look at creating a portfolio and trading in and out, because if you have listed bonds, then there's a potential for you to benefit from listed bond taxation. But this is a high churn strategy. It requires a lot of attention, effort, and bond picking, so to speak. So I'd like to just share a little bit about Milestones to Wealth before we go forward. So Finesse is an initiative within Milestones to Wealth to talk about uh, fixed income investing, essentially. So here we help investors grow from where they are to their first goal in financial savings, and we're able to handhold investors in this journey and give them the guidance that they need at any given point in time to help them achieve bigger milestones together. So our goal is to help every investor think big. At Finesse, we publish a monthly fixed income outlook. We also have these kind of webinars. And if you have any other questions, then we can start talking about it right away. So